standing in for him today. And we have a goal of exploring community capital innovations, both local innovations and those related to economic development. And hopefully, what we cover in these webinars is not just academic information for you, but can help you help to inspire you to borrow, invest locally, to build institutions in your own backyard. I guess the phrase that we embrace is BIMBY, begin in my backyard.
That's great.
The sponsors for today's event are the newsletter that Jennifer and I publish, the Main Street Journal, also Neighborhood Economics. The main people, I should mention, the main people involved from Neighborhood Economics live in Asheville, and they were absolutely devastated by the hurricane. So you will see them intermittently over the next month. And then the American Independent Business Alliance, Amoeba, and Impact Alpha. So today's focus is going to be the Vermont Community Loan Fund, and this is one of the longest standing institutions in the United States that allows grassroots investment to support various forms of community development. And we're very pleased to have with us Jake Ide, who's the Director of Investment and Philanthropy for the fund. And here's what we're going to do. I'm going to hand it over to Jake, and he's got some introductory slides that he's going to share. And then I'm going to follow up and ask him some hard questions to just give us a little more color about the fund. And then I'm going to hand it over to you. So please write down your questions. We're probably will be a small enough group that people can just get off mic and ask things. We don't need to formally put it in the chat, although if you want to throw things in the chat, you're welcome to. So Jake, thank you so much for giving us your time on this election day when we're all looking for distractions. But you're more than a distraction, you are an opportunity. So tell us about what you do.
Yeah, thanks, Michael. And I'm actually gonna wait till hold off till we get to the kinds of the clients, the folks that we serve to go through those slides, but I can start rolling into the questions.
Okay.
First, just want to thank everyone for being here. It's I don't know about you, it's a difficult day for me. It's a difficult day. Unfortunately, the problems that I came to work to try and solve yesterday are the same today. Nothing has really changed, unfortunately, except our operating environment a little bit. The lack of equity, lack of justice has existed as part of this country's character and has existed for a long time. So the work that the Loan Fund is doing gives me power today, helps me feel better today. Today is my mom's birthday. I won't say how old. Happy birthday, Martha Ide. Tomorrow is my daughter's birthday. Happy birthday, Alice. So I got it today for my mom. I'm getting up tomorrow for Alice, and I'm going to figure out who's next the day after that, and we'll just keep going the way we do. But thank you for being here today and for focusing on this, trying to focus on this. However folks want to show up in this room is fine with me. I really understand. Again, my name is Jake Ide. I'm the Director of Investment and Philanthropy at the Vermont Community Loan Fund, and I use he, him pronouns.
Great. So let's start at the beginning, Jake. The fund was founded when and why and by whom?
Yeah, the fund was founded, like you said, one of the oldest community development financial institutions, and I'll say what that says and what that means in a sec, but one of the oldest CDFIs in the country, founded in 1987 to address one problem, which was a systemic lack of access to capital for all Vermonters. I think that folks kind of probably have an image of Vermont, or a lot of folks have an image of Vermont that's based around our identity as a vacation destination, or maybe you think of Ben and Jerry's, Bernie Sanders, certainly lately, Hadestown, if you're cool. There's lots of great stuff that helps to define Vermont, and I think that it helps to gloss over a lot of the problems that exist here as they exist in lots of rural communities. Vermont is one of the most rural states in the nation. And so we suffer from that insidious form of poverty, rural poverty, that I think is more spread out, and harder to say that this census tract is a census tract of need. I think that it's more widespread and kind of entrenched in our communities here. And so Vermont has always had a need for a special kind of very rurally focused economic development. Kind of the initial genesis of the fund began in the mid 80s. Folks might remember that there was a rising awareness, at least in this country, around investment choices that people were making, and specifically divestment. There was a lot of news cycle given to, I think, the Coca-Cola company's connection to the investment in the apartheid government in South Africa. A lot of folks were asking questions at that time about what their investments were doing, thinking about their investments and their money as the tools that is mobilized by the companies they were investing in, and what it was doing, and specifically what it was doing that they did not agree with. And so there was a rising awareness around divestment at that time. There was also, the Reagan administration was in power and was slashing affordable housing programs. And so a group of Central Vermonters that had gathered at a conference around divestment at Goddard College here in Central Vermont, where I am, we're talking about divestment, and they all had, a lot of them had, were at work in this fight for affordable housing at that time. And so they were thinking about different ways that they can mobilize capital for affordable housing development in Vermont, and to invest in affordable housing development, which then was the real need that they identified. At the time, there was a state entity, the Vermont Housing and Conservation Board, which was a funnel for state funds and federal funds to affordable housing development, such federal funds as there were at that point. And these folks were thinking about a way for regular folks, private individuals, that private money to be mobilized to support this work as well. And so they were sitting around a picnic table at Goddard College, and essentially became the steering committee that became our first board of directors. And they were the initial investors in the fund as well.
Interesting. So, and what were the priorities? Was it housing, or were there other things as well, business associated with housing?
It was housing at that time, and very specifically housing. And as the fund grew, and we encountered more folks with capital needs, I think that we were able to diversify, first to lend to other nonprofits and community facilities, arts organizations, rural health organizations. Things like that were a pretty easy fit. And then by the 90s, I believe the mid 90s, we capitalized a small business, local business investment fund, and made the first pilot loans out of that fund, and then launched a small business program almost immediately after that. That program further diversified in, or has diversified ever since, really. We have a program dedicated to early childhood education businesses. We have a program dedicated to working lands businesses, which of course is a big part of the Vermont economy. We have a program dedicated to smaller working lands businesses, the Sprout program versus, sorry, I meant outdoor recreation. The last one I was talking about, outdoor recreation businesses. And most specifically, the Justice Forward Fund, which is a financial fund that we've launched specifically for Black, Indigenous, and Vermonters of color, kind of most recently. So once we got into financing business, we continued to kind of segment out and find different pockets of need where we could deploy capital.
So let's talk about some of the numbers around it. So how big is the fund? How many people participate in it, and how many businesses or projects are beneficiaries?
Sure. So big ticket numbers right now. So as of October 2024, the size of the loan fund, we've got about $31.2 million in loans outstanding to 290 projects. We make those loans with about $33.4 million in impact investments. That is the funds that folks have invested in the loan fund. And we can talk about how that structure works, but that's essentially the capital that we're able to lend is capital that's loaned to us by impact investors. Got $33.4 million in that right now. almost $18 million in equity, that permanent capital. Other nonprofits, it would be their endowment. We use that equity to be able to go out and leverage additional debt, go out and borrow more debt to be able to do more work and serve more folks. So that's a rolling figure as well. But that puts our net assets at around $55 million, which, depending on where you are, that feels big for Vermont. It's small it's bigger than a lot of CDFIs, and it's smaller than a lot of CDFIs.
Where did that founding equity come from?
The founding equity primarily came from philanthropy and from a department, ultimately from a Department of Treasury program called the CDFI Fund, or Community Development Financial Institutions Fund, which was created to provide support to organizations like us, CDFIs. And so that grant support has actually provided a lot of equity over the years. It's an incredible grant program in that they match one-to-one all of the philanthropy that you're able to raise, the support you're able to raise. So the CDFI Fund has essentially doubled the loan fund's philanthropy since 1996, which is an incredible tool for a nonprofit's growth. Like, that really helped fuel our growth because we had to raise the money and then they doubled it for us. So that grants from there, bequests, we're a nonprofit 501c3, so we rely on grants and philanthropy for our support our operations, and so bequests, end of life gifts, other grants for permanent capital have been a big part of building up that our ability to be able to go get more debt.
So, given how you've grown, if the philanthropy, I mean, you have the money in the equity now, as a result of prior fundraising, is that enough for you to operate profitably, or at least with, without taking losses, or do you need philanthropy to kind of keep going every year?
It's not necessarily the losses that create the delta in what we need. Loan fund, it's because our losses, and so let me say this right out loud. Our losses are incredible. Our loss rate is incredibly low. It's less than 2%, or call it 2% for that 38-year period. So we've lent almost $150 million and have been and have essentially lost less than 2% of that. To be clear, those losses were our losses, not our investors' losses. So we've borrowed all that money historically and never failed to repay an investor on time, with interest, according to their wishes, exactly as planned.
Okay. Have you always allowed grassroots investors to participate, or was that a more recent feature?
It's always been part of the loan fund story. Like I said, the initial founders were really looking for a tool to leverage and mobilize private capital to supplement and augment this source of state and federal capital for affordable housing development. So the initial founders' goal was always to source money from individuals, which is relatively anomalous in our industry. CDFIs are financial institutions, and we offer financial products and services. A lot of CDFIs get most of the capital that they lend and a lot of their operating support from other financial institutions, from big banks, some community banks, but a lot of larger banks, national and international banks. And so our ability to raise money in smaller pieces from regular folks is a different kind of model. In an operating environment like the aftermath of the Great Recession in 2009, 2010, 2011, 2012, you saw banks and financial institutions really tightening up on credit and being really uncomfortable in an uncertain operating environment. That flowed through to CDFIs. A lot of CDFIs operations and lending were constrained. They weren't able to meet the community needs that they were seeing at the exact time that they needed to be out there doing that work. Their sources of capital were holding them back. Our sources of capital are different, and it requires a little bit more work because I'm dealing with people in smaller chunks. You can invest $1,000 at the loan fund, and we have folks with over $1 million. But so we're dealing with a bigger group of investors than maybe some CDFIs, and there's some cost or some work associated with that. But individuals and grassroots investors give us a power, and they have an emotional connection to our work, and so they're more likely to support us. Our investors, which are about 60% individuals and families, our reinvestment rate is very high. 4 out of 5 investors, when their investment matures, renew their investment with us at whatever the current rates and terms are. So we know that they appreciate the work. We know that they're moved by the work. We know that they want to keep doing the work with us. And that is something that I don't think you get as much when you're dealing with an institution.
How many individuals are involved in it now?
We've had historically over 900, and today we are at about 450. I'm just scrolling through my notes to find that exact number. Today we're at about 450 investors with about 660 investments. So folks can ladder capital, they can have multiple investments with us. We allow the investor to do that as well.
And these are primarily Vermont residents, or what's the ability of outsiders to participate?
Yeah, the financial regulations in Vermont make it very easy for Vermonters to invest in the Vermont Community Loan Fund. And it is easy for folks from other places to do that as well. Where the complications come is that investing in these kinds of things and moving money this kind of way is governed state by state. And so the regulations are going to be different in every state. There are states in which I would have to do a lot of work to be able to offer our investment products to folks in those states. And because we're able to meet our capital needs based on our current structure, we're not doing that work. I'm not out there trying to get into states that I haven't been in yet. So I've got a list of states that are okay for folks to invest in. And we have some experience in doing that. And so if investors are curious about that, they can definitely reach out and we can definitely talk through how that works.
Excellent.
Yeah.
So I did identify, before we went live here, I identified that as a Californian, I am able to invest and probably will. So I'm excited about that.
Oh, it's wonderful. Thanks.
So what is the typical size of people's investment, and what kinds of returns are you paying on the money that people put in?
Sure. Our overall, so we are a mix of investors. It's not all individuals and families. So right now, those folks make up 50% of our investors by by dollar amount. So a little over half the capital is supplied by regular folks, and over 82% by number. So by number, our individual investors really run the show. Another interesting stat about that is that 72% of the money invested with the loan fund is controlled by women. So the loan fund, while we seek to serve women and serve women at higher levels as well, like I said, we're trying to serve underserved folks. So in Vermont, that's women, lower income Vermonters, and Vermonters of color or BIPOC Vermonters. Right now, women, 62% of our borrowers are women, 56% are lower income Vermonters, and 26% of our business borrowers today are Black, Indigenous, or people of color. So in the same way that we're trying to diversify the capital going out the doors, we're also giving groups and folks a way to direct their capital towards things that they care about. And I think that that's a big part of why a lot of women have found the loan fund a valuable tool for deploying their money into the world and trying to make change, starting back with the Sisters of Mercy, who were a huge part of starting the loan fund and investing initially and giving us our initial capital, as they were with CDFIs around the country. The Sisters of Mercy really felt and continue to feel very strongly about their money mirroring their values. They are investing the sisters' assets in the things that the sisters would be proud of. And so they were a big part of starting our journey. Forever grateful to them.
That's great. So tell us about some of the success stories, some of the beneficiaries of the capital, and
Sure.
what you've been able to accomplish.
So I'll share my screen a little bit just so I can show folks some slides. On the right button here. Okay, so folks can see the Champlain Housing Trust slide.
Good.
Okay, wonderful. So the loan fund is a pretty diversified CDFI. Like I said, we started out lending for affordable housing, and today lend for small business. We lend for early care and learning business, and we lend to other nonprofits and community facilities. So here's just a couple of snapshots of different folks that we're lending to. The Champlain Housing Trust is the oldest and largest, somehow, community housing trust in the United States. And it exists in Burlington, Vermont. Started in Burlington, Vermont, exists in Burlington, Vermont. It's a really incredible organization. They are our largest single borrower, and we've had a relationship with them, multiple loans at all times, going back the 38 years that we've been in business. These slides are from an incredible project on Bright Street in the old North End in Burlington, which actually took some time to develop. It was a new loan product for us at the time. It was a land banking loan product, so we were able to help acquire a lot, and then another contiguous lot, and then another lot next door, and string together these 3 lots into a larger development that ultimately ended up being 60 new homes in the old North End, which is a population center in Vermont, and also a center of population for a lot of BIPOC Vermonters and New American Vermonters. Vermont is a really active refugee resettlement program, and so it's just an incredible program, right where it needs to be. A very special borrower. Sweetland Farm down in Norwich, Vermont. We have a lot, as you might imagine, if you think of Vermont, a lot of agricultural borrowers. We have a couple of loan programs specifically around food farms and forests. Enora Lake is one of our great borrowers from Sweetland Farm. She got a loan back in 2017 to expand her barn and her farm stand. So she bought a veggie wash and pack station. She built a teaching kitchen, installed some coolers. It just was a great project. Family-owned, woman-run farm. Great CSA, community-supported agricultural program where you buy a share and you go and get your food every week. So there's an incredible community connection component to her work. Just a really cool operation. This is one of many farms like this that are represented in our portfolio. Okay, here's another one. This is a newer one that came out of our Justice Forward Fund last year. Haji Driving Academy. So Aiden Haji was Somali Bantu, born in Kenya. He came to Burlington to go to UVM, and he stayed in Burlington. He's an incredibly active community member. He's on the Burlington School District School Board. He's a commissioner on the school board. He worked for Spectrum Youth and Family Services before he started his business, which is a big family services, community service organization in the area. So deeply rooted in the community, really connected to the community. And through that connection and through his experience, recognized that there was a need in the community, in the refugee community, to learn how to drive. Vermont is a very spread out state. We don't have incredible traffic or transportation infrastructure, and really you need to know how to drive yourself around to be able to get to your job, get your kids to daycare, things like that. And so Aiden formed a driving academy. He's now full out. We made him a small loan through the Justice Forward Fund to buy that Camry that he's driving. Hunger Mountain Co-op. This is great. One of the questions was around local ownership, and this is one way that we kind of inadvertently promote local ownership. Well, we've lent to a lot, like a lot of CDFIs have lent to a lot of co-ops, real estate co-ops. We've done some community solar lending as well. So the cooperative movement, the cooperative structure really appeals to us. Community ownership, democratic ownership is really important to us. Hunger Mountain Co-op is the co-op in capital of Montpelier, where I'm standing today. It's 170 employees and sources from 500 local vendors. So with this one loan, we're essentially supporting or promoting 500 local vendors to the co-op's about 8,000 members. Again, like with Nora, it's kind of funny looking at these slides in sequence. We finance freezers. Apparently freezers is something that we finance pretty regularly, cold storage. And they've just been a great partner. Hunger Mountain, we made the loan for them to move, or we were part of the financing for them to move into their modern space. Before that, they were very, very small, and we made a couple of loans as they grew into that. Now that they're at the scale that they're at, they have taken some of their assets and invested them back into the loan fund to be able to promote the work that we're doing and use their own assets to engage with their community through VCLF, the way that they were supported as they grew. Just an incredible organization and a great story in that they are now an investor as well. So this one, I grew up skiing at this mountain. It's a ski trail. That's why it makes sense. And childcare names can be confusing sometimes. This one's special. Little Dipper's Doodle Child Care Center. It's in St. Johnsbury, Vermont. It's in an industrial park where there are swing shifts and round-the-clock work. And so they have extended hours. They're open from 5 a.m. to 6 p.m., which is incredibly rare in this industry. But really, they needed to be able to serve the community that they were serving, the employees in that industrial park. They're serving 165 kids from infant to school age. They're a highly, highly rated program. And we have made multiple loans to them, which is not uncommon for us. Not necessarily at the same time, but in sequence usually. A lot like with Hunger Mountain, we're able to grow with someone as they grow. And the next time they have a financial need, maybe it's too small for the bank to notice, or maybe they're still not bankable. I put that in air quotes, bankable. We find all these people are pretty bankable. But we're able to help them keep going when they need their next loan as well, which is a place that we strive to be. Finally, Living Well Community Care, another long-term partner. They had a smaller home-based senior living facility in nearby Bristol, but we financed their acquisition of a new program in Burlington. The Ethan Island residents and actually provided a lot of financing and helped organize a financing package for an elevator to be able to access the second floor of the building and to be able to help that program grow. Today, they're serving 105 seniors, which is a huge need here. Vermont is the second oldest state. Last I checked, we might be the first at this point. So that's just a snapshot of the folks that we're lending to. Like I said, we're lending for affordable housing. We're lending to businesses really of all sizes, shapes, and stripes and ages. And we take them case by case. And lending to early care and learning businesses and other nonprofits and community facilities.
That's great. And really, really terrific slides. Give us a nice flavor of all this. I've got a zillion other questions, but let me open it up to others gathered here. And if you raise your hand either electronically or with a hand, I will call on you, and we're a small enough group that we can do this informally. Yes, Nicole.
Super interesting presentation, Jake. Thank you. One of the questions I had, especially as you were talking about like multiple loans with the same group, over time, I'm assuming there's some element of like business services, business planning. Like what kind of support do you give to the folks who you are lending to, if this is sort of the idea of patient capital over time and they're stacking loans, that gets to a higher risk category with growth over time. So Hunger Mountain was a great example of how you can pay off your loan and become an investor, but I assume that's rare. So how, what else do you provide to folks that are, that you're loaning to?
Yeah, so a lot of the, thanks, that's a great question. And you're correct. A lot of the folks that are coming to us, especially the business borrowers, they can be young businesses, they can be startup businesses, they could be businesses, I don't want to say in crisis is too strong a word, but they could be businesses that are looking for a loan and it's existential. They need a loan. They need help now. And so the folks that are coming to us obviously have a capital need. Often they have non-capital needs. And we noticed that most, or it kind of became most pronounced when we started lending to early care, early childhood education businesses. That's a really specific, and I can only speak to Vermont, I'm not an expert, but it's a very specific business model where you're cash flowing your business from payments from families, from the federal food subsidy program, from state subsidy. It's a really labyrinthine, confusing business model, and the people that are running these businesses usually don't have a lot of business training. And so that was where we realized, oh, we should, the more business counseling and business planning and things like that we can help folks with, the more successful we're going to be. We definitely know that we can help with capital needs, and we need to get better at helping with folks' non-capital needs. So that ultimately led to the development of our Business Resource Center. Began as a resource for early childhood education businesses, and now is available to every VCLF borrower free of cost to them. And in fact, we even have some money for third-party technical assistance that we can help with if we can't meet their needs internally. The curriculum that we're able to offer is a one-on-one, largely a one-on-one curriculum. We like to meet directly with folks. We don't do a lot of group trainings. We tend to meet most one-on-one with folks, and I think that gives the best results. But yeah, we can help with general business planning, organizational development, financial management, strategies and planning, succession planning. We do a lot of personal financial coaching. A lot of times the folks that come to us, their business finances are kind of inextricable from their personal finances. It's all the same. So we help to thread that needle for them and figure that out. We can do service and products, cost analysis, marketing, sales strategies, things like that.
So if I can piggyback a question onto that,
yeah,
what percentage of the businesses actually require some form of technical assistance?
We don't require technical that any of the borrowers, or typically, I should say that there are some loans that we make that do require, and you see this in loan committees sometimes, where the need is identified, that what the borrower needs is identified, and maybe they're already working with us on that need with the Business Resource Center, but we do sometimes put that covenant in loan agreements where, we require folks to work with our Business Development Center in whatever form that takes. But it's not necessarily mandatory. And I find that a lot of the folks because we're diversified, our affordable housing developers, Vermont is blessed, thank God, with a very established, very strong network of regional affordable housing developers. They have incredibly deep expertise. They don't tend to need a lot of additional assistance from us. They just need the capital. That's a different audience than our small business borrowers, where we do work a lot more closely. So most of the business resource work is with business borrowers. I don't know exactly how many of them are active in that.
Right. But it sounds like you've got a good arrangement so that some of it is offered as a service by others outside the fund. So it's not a huge cost item for you.
Yeah.
Carl, I'm sorry, go on.
No, and like I said, we've got some third-party money as well. Our TA program, the Business Resource Center, is largely funded by some federal grants from Small Business Administration, Economic Development Authority, and then funded by philanthropy that I go out and raise as well.
Carl, I saw you had posted a couple of questions. Why don't you run through them? Whoops, you are still muted. Let's see if we can get you on. There we go.
There we go. What are you paying to the investors, and in return, how much are you marking that up, if any, to the businesses that you're lending to?
Yeah. So our investor rates right now are actually inverted for the first time ever. They've always been linear, with the lowest rate is going to coincide with the lowest term. So our investment product mimics a certificate of deposit, or CD, where the investor obviously selects the amount and selects the term, and then the interest rate that they're going to earn is going to be fixed over that term. They can decide how regularly they want to receive that interest and in what form. It can be reinvested into the principal. It can be paid out however folks like. But right now, our interest rates are 1-year rate, mimicking a little bit the current, or very much the current CD environment, where the short-term money has the highest rate right now. Our short-term rate, our 1-year rate, is 3.5%, and then it goes like a U kind of. So it goes from 3.5 down to, I guess, the 5-year rate is 2.5, and then back up to 3% for 10 years or more. And we are, as you say, marking it up. Our business model is that we borrow capital at a lower rate and lend it at a higher rate. We're able to generate some income for the program, but our loan fund does not cash flow. We're a 501c3 nonprofit, and we're constantly plowing the assets back into the work and doing more. And so our goal isn't necessarily cover all of our costs on that spread between interest rates. That said, our interest rates right now, the low rate is 2% for a couple of business programs. And the highest business rate right now, I believe, is 8.75%.
And then is it all debt, or are you doing any equity investment?
It is all debt. We're not doing any equity investment.
Okay. Other questions from folks in the audience here? Yes, Nancy. Yeah, and you need to unmute. Almost. There we go.
Okay. I think you, Michael, had asked, but I'm not sure if an answer was given to what the average investment amount is, or what the range of investment amounts.
Sorry about that. Yeah, that's true. Thank you, Nancy.
Well, that way you know we're listening.
Sure. Yes, you could keep me on my toes. So our average investment, I can tell you our range, and folks can invest as little as $1,000, which of course is not little for everyone or anyone, but start at $1,000, and we have relationships with individuals that are up over $1 million. Some of those federal sources, USDA Rural Development, is a department that we have a number of $1 million for. And then we have some relationships even in the state. The Vermont State Treasurer's Office has an investment of $1.5 million that I'm talking about raising pretty substantially at their request. So a lot of sources flowing into the loan fund. The average, I think, ends up being for individuals is probably around $35,000.
Okay.
But like I said, we start at 1,000, we go up over $1 million. We can ladder it and structure it however folks like. I find that our investors get pretty creative.
Okay, thanks.
One of the things that I've observed in Vermont is it's a small enough state that everyone knows everyone. And you know, it's not, if you want to meet with, say, the securities regulators, chances are good if you go to the coffee shop right outside the regulator's office, you're going to have a spontaneous meeting.
Right over there.
Yeah. And so I was interested, your first slide was on one of my favorite examples, which is the Champlain, housing trust.
Yeah.
And one of the things that's interesting about it is that it started in part with a seed grant or seed money from the city of Burlington that was raised in part through a municipal bond.
Mm-hmm.
And it suggests like there's an interesting interplay between what city, county, and state officials do in terms of public policy and the way that you can be responsive with your capital. And so, you know, city starts this, you come in and provide a ready source of money to make it easy to grow the property asset base. Are there other examples of that where there's been an interesting interplay of public policy that we should pay attention to?
Yeah, a couple of things. And like I said, you hit the nail on the head. We were started as a way to leverage government funding to really be the private piece to government funded deals. So we've always had a great relationship with the state, and you're right. The state house is right up there. We can walk up there. We can talk to folks. It's accessible. The Department of Financial Regulations is a big supporter of our work. They're very accessible. The Treasurer's Office is an investor, has been an investor for over 20 years. They're very accessible and supportive as well. So we're lucky in that, like a lot of CDFIs, we're really engaged with public policy in our state and with the landscape around economic development, rural economic development. One thing that I call out here that's pretty neat is that there is a charitable housing tax credit, something called the charitable housing tax credit, where folks that invest in the loan fund and dedicate their capital to affordable housing development actually don't earn any interest from the loan. It frees us up from having to pay interest to them. The state, in fact, will pay them a tax credit based on their Vermont state income tax liability, which is a pretty neat program as well. That is relatively rare. There aren't a lot of tax credit programs other than the low income housing tax credit, which is a pretty standard way for CDFIs to engage in tax credits. But it's a pretty neat state function that has benefited us to the tune of maybe $5 million in impact.
How generous is the tax credit?
It is keyed off a couple of things, but it's maxed out right now. It's at 3%.
Okay.
Which is going to get you, that 3% tax credit is going to ultimately get you more return than 3.5% interest from me that you're then going to get taxed.
Absolutely.
Yeah, it's pretty cool.
Excellent. Excellent. Other questions from folks here in our room?
Jake, do you ever tie your loans together where a loan to a business is contingent upon working with your housing project or vice versa?
I'm trying to think. I don't think so. I don't think we've ever done that. But I'm probably forgetting a time when we have.
All right. Yes.
Michael, I guess, I don't know, this is kind of a not fully formed question, but I guess in the sense of like, I'm seeing this, 38-year, almost 40-year history, how the fund was started with CDFI money that's, not always present now in the ways that it was then. Like, do you have any advice for folks that are trying to start community funds now, based on your experience and how you've seen it change over time? Again, that's a pretty broad-ended question, but I know Michael's familiar. I'm from Rhode Island. There's a fund that's trying to start now. And I guess I'm like, God, how many times do we have to reinvent the wheel? Are there folks that can tell us something that we could learn, from this if you're starting in the now?
Yeah. Yeah, I mean, our initial, so I've been at the loan fund for 19 of those 38 years, which is a long time, but we were ultimately pretty fully formed by the time I got here. My arrival was, though, the first time, and it was in response to a couple of years of strategic planning, I believe, that the board and staff really needed to put the organization on a sustainable course and realized that they needed to hire someone to really actively manage and try and grow both the investment and the philanthropy side of the loan fund. And so that seems to be, when I got here, and this is not even mostly just me. When I got here, we were a $14 million loan fund, and now we're a $55 million net asset loan fund. That investment paid off. We really were at a place where it was time to dedicate staffing time to bring in the philanthropy that was going to be the equity that would then allow us to go get the debt. So ultimately, it was an investment in staffing around philanthropy, which is not a great answer for you. Like, of course, yeah, hire someone to go get money, right? But that's that, at least in the history of the loan fund, as I was trying to think about, Michael actually asked that question. I was trying to think about what advice I would have. It's definitely that. And then it's to get engaged. It's to get engaged with some of the CDFI community. There are a million different kinds of CDFIs, and what they share is a commitment to moving money for justice. And they've found a million different ways to do that. And so engaging with their CDFIs like us that are heavily reliant on philanthropy and investment from individuals. There are folks that aren't, and they can work too. There's a million ways to do it. And so, learning what you can about CDFIs, engaging with your local CDFI to talk to them about what might be existing in your operating environment down in Rhode Island. I know the Capital Good Fund is working down there, right, in Providence. Andy Postman, I think it's the Capital Good Fund, and yeah, it's not a great answer, but that's the truth. I think we really started to get sustainable when I was hired and when there was assets dedicated to philanthropy and going with it.
No, I appreciate that. I mean, it's a hard question, right? To go back
Yeah.
40 years and be like, I mean, people ask us about equal exchange too. And I'm like, God, trying to start a co-op now with the capital model that we were able to do 40 years ago is not an easy question, you know, but
Nope.
it's helpful to hear from your experience. And yeah, dedicated fundraising is always a issue for nonprofits, and you're doing it one way or another. So thank you.
Yeah, of course.
Have you found ways of engaging your 450 plus people who are investors? Do they, play any role with respect to decision making, or do they get lists of things that they should be buying locally as a way of supporting the recipients of the investment?
Yeah, we've done that a lot. Our communications are largely focused on our borrowers and telling our borrowers stories. So we've done the thing like, hey, do your holiday shopping at these borrowers, and try to engage in things like that as we can. Our investors we do have investors on the board, and we do have investors on the loan committees. Decisions at the loan fund are made primarily by one of 3 different loan committees. There's a business and early childhood education loan committee, a housing and community facilities loan committee. Those both operate at a larger scale than the 3rd committee, which is an internal committee that's only staff that has authority up to $75,000. So we can make smaller loans, micro loans, and a little bit bigger as a staff or as a subset of the staff that makes those decisions. And then the other decisions go out to committees that that incorporate board members and investors. One thing that we're doing as part of our Justice Forward Fund, which I'm gonna just take a couple of minutes to talk about that, but that is a way that we're going to that we're bringing folks in, and both investors and borrowers are going to have more of a say in the decision making for that program. We're instituting a loan review committee for this one loan program that's going to essentially review loans that through the other channels don't get made for whatever reason. So they're going to look at rejections essentially, and make sure that we're okay with being those rejections. And they're going to have the authority. And again, this is going to be dominated not by staff and not by board. It's going to be investors and community members, which for the Justice Forward Fund is BIPOC Vermonters, are going to have the authority to make those decisions. And that'll be a new model for us. That's going to be an interesting kind of evolution to the loan fund, but I think it's totally appropriate, and it's going to be really cool. It's definitely fulfilling the promise that we have, that the community that we're serving controls the capital that is serving. And so, yeah, I just want to talk about the Justice Forward Fund for a second, because
go ahead.
It's more germane today than ever. So we have launched a racial justice loan fund called the Justice Forward Fund, which we piloted last year, and the board allowed us to do $1 million pilot of this loan fund. I'll kind of explain how it's different than the rest of it. Those were kind of the guardrails put on it. So we've been through that process. We've successfully completed that pilot. We've gone and studied what we learned from the pilot, and we're relaunching the program this fall. So the Justice Forward Fund is the Vermont Community Loan Fund's attempt to redress racial injustice, inequity, and inequity. The way that the JFF works is that it's a microloan program up to $50,000. And it is our lowest interest rate capital that we offer. We're still nailing down the numbers on what that looks like. It was largely 0% capital during the pilot. And again, just because of sustainability, we're trying to get as close as we can to that. It looks like it's going to be around 2% maybe for this coming period. That could go down if we secure more philanthropy to buy down more interest rates, but that is our lowest cost capital being put out the door into the hands of Black, Indigenous, and Vermonters of color. We don't do any fees for that program. So there's one flat, or we do a single $60 fee for that program in lieu of the fees that we would usually charge borrowers origination fees, legal fees, documentation fees, usually runs about $700. We're waiving all those fees and eating those fees, but we're paying those fees ourselves. It's a streamlined application process, so it's a smaller, simpler, easier loan application, and it's an expedited decision-making process that we're putting into place, where these loans are going to move through the loan fund much faster, and we're going to be able to do more at scale. That was one of the big things we learned from the pilot, was that in closing these 40 extra loans, essentially, for $1 million, we needed to staff up, and we needed to change our systems in a way that was going to allow us to keep doing this and keep doing it at the scale that we wanted. We didn't want folks to come to us and need us, and we're like, okay, give us 6 weeks, we'll get right to you. That's not at all what we're trying to do. And so we needed to streamline some processes. Our loan team is absolutely incredible and has done an incredible job coming up with a new rubric to assess and make these decisions much quicker, which is going to be incredible. Like I said, we're going to create a loan review committee that's going to have authority ultimately to make loans that will not be controlled by VCLF board and staff. We also don't have a collateral requirement. We secure all the loans that we make, just like any other lender. We secure it with business assets or real estate or personal guarantees sometimes. For the Justice Forward Fund, I think that we took personal guarantees and we didn't want to deal with collateral beyond that. That is a recognition of the fact that most people of color in this country don't have access to the assets that most white people have access to, and have not been able to build that generational wealth. They might not own their home at the rate that they definitely don't own their home at the rate that white people do. And so they don't have that asset to be able to go and leverage and borrow against. If you don't have a thing to pledge, you can't borrow. And so we're waiving collateral for this and using, well, I'll talk about what we're using to be able to do all this stuff. And we're also not considering credit score. We ask people for their credit score, and it does play into the decision-making process, as far as being that expedited process or just being the regular process. So they can get fast track for having a good credit score, but you won't get denied for having a bad credit score. And in fact, we're not really even using it. It's just kind of a data point that we're collecting and are interested in, but it's not making decisions, not guiding decisions. We don't think that that's an equitable approach. So how we're able to do this for the Justice Forward Fund, it looks much different. Like I said, low interest rates. We're foregoing a lot of program expenses that would be generated, paid for by the borrower. We're recognizing that the borrowers we want to serve can't pay those. We don't want them to pay those. So we're paying them. And essentially it's a subsidized loan rate where we're taking our regular capital, which has a higher rate, whatever we're paying the investors, and buying down that interest rate to essentially in the pilot to 0%, but probably to 1 or 2 for the ongoing program, at least in this first year. And so there are 2 things really the Justice Forward Fund needs that are different from what we normally do, or kind of heightened. One is that additional philanthropy. We're buying down interest rates, we're covering costs. The loan fund is doing some of that ourselves, but we need more philanthropy to be able to do that. This program costs more. It costs us more to do this work in this way with this community. We are going to do it. We're going to be here doing it, and we need extra help to be able to do it. Another thing that we're going to do that I'm going to ask folks to do this fall and beginning next year is when investors come to VCLF and want to invest in the loan fund, welcome. Please invest with us. I hope that you will consider investing a portion of that capital, whatever you are going to bring. I hope that you will consider investing a portion of that capital at 0%. Essentially sharing it with us. We're going to lend that out at 1 or 2% and be able to cover some of the costs associated with that program. So we're asking our investors to make the ultimate sacrifice in this game, which is you're not going to accrue any additional capital. You're going to take that capital that you would accrue, and you can consider that a gift to the people that we're trying to serve. And I'm hopeful that investors will see the value in that and want to play a part in that. That 0 cost capital means we don't have to buy down the interest rate. And so it's another way that we can do more through the program. We're going to have to stitch together both of those things to make it work. And we will. But yeah, so anyway, thanks for that. Just platform to talk about the Justice Forward Fund for a sec. It's the work that we're doing that excites me the most, and a lot of the other staff as well. And it's right where our organization needs to be. And it's awesome.
That's great. Well, appreciate all of this information. If people want to get in touch with you or maybe look more at the fund, what should they do?
Yeah, absolutely. Our website has tons of information on it. It's investinvermont.org, and you'll find all of our investment products. We have an offering memorandum for the more technically inclined. You can read all about the regulations that govern investing with a loan fund. We also have a lot of other incredible publications, impact reports, annual reports, newsletters, stories, borrower profiles, the real work that we're doing. You can find it all on the website. You can definitely always get in touch with me too. My email is jake@vclf.org. It's that easy. And you can definitely find me on the website as well and everywhere else.
Great. Well, thank you so much, Jake. And just to round things out, I asked Jen to step in for a second and let us know what's coming up in our next couple of webinars.
Yeah, fantastic. Thank you guys all for being here. Thank you, Jake and Michael. It was a great conversation. Just know if you have to, skip out really quick, that I just put a link in the chat so you can get every single event that we have planned. But November 20th, we're going to have Chicago Trend. And then in December 4th, we have Kensington Quarter Trust. And then December 18th, we have RSF Social Investment Fund. I will definitely send you an email with a recording, any links that have been shared. Thank you, Nicole, and other questions that people have. Just know that this is not the end of the conversation, but just the beginning. So thanks again.
Thanks, Jen, and thanks, Jake, and thanks to the rest of you. We'll see you all in 2 weeks.
Thank you.